So I have been asked numerous times over the course of the day to comment on the price of oil, to put a video up about what's going on in the oil market, and to comment on the valuation of the SNP500 and why it's at the levels that it's at. So those are two separate thoughts. Let's start with oil. I don't think it's any secret what happened with WTI, West Texas Intermediate, today. It started the day at $17, $18 a barrel. When I say the day, that means midnight of last night. After lunchtime, it hit zero, broke through zero, and continued to go negative. And it's trading still after hours. I think it's negative $15, negative $16 a barrel right now. On the screen, you can see a chart of WTI for the day. And this is from Interactive Brokers. Notice how it flatlines at the zero mark. I'm not sure that IB has the algorithms to produce a chart with a negative price. So you sort of have to start thinking about that in terms of what your broker can display to you. Do charts simply bottom out at zero and then you have no visibility below? I was able to get a chart up a little while ago with the negative pricing, but I can't seem to get it now. All I'm getting is this one flatlining at zero. But anyways, you can really see the drop off here. This we can see the time here was at noon, and right after noon you can see it just was a straight drop down, and I was watching it and I could not believe how quickly it dropped. It was sitting around $10 for a while. I simply turned my head for a bit. I was doing something else, looked back, and it was $5. And again, I was distracted a bit. I was looking at other things, turned around, it was at $1. And then I watched it from $1 drop down to 80 cents, 60 cents, 40 cents, hit a penny. And then when it hit zero, I didn't have any more visibility. And it continued to trade negative after that. So there's our chart. Let's have a look at the pricing of where it is now. So here we are. Here's the May contract. It's negative 16.72, negative 16.20. So if you were to buy this contract now, you would get, because it's 16.71, it expires tomorrow. And since it's negative 16.71, each contract is for 1,000 barrels. You'd get $16,710 if you bought this contract. You would get $16,000 for buying it, but you would have to take delivery, and you got to put it someplace. Now, we've seen examples of milk, of dairy farmers, when they have excess milk, they could just dump their milk down the drain. Can't do that with oil. You got to put it somewhere. And where are you going to put it? You got to put it somewhere. So a truck shows up, or you show up down there. First of all, you got to get a truck. You got to go to Cushing. You got to take that oil, and you got to bring it somewhere. Leaving it in that truck, you got to rent that truck for 30 days. Well, if the price of oil doesn't go up, right? So I'm going to show you the next month contract, which is at 21, and we'll try to explain, well, what's the difference here between we have negative $16 and $21 on the price of oil. 16 doesn't reflect the spot price, by the way. This is a lot of long positions that have to get out at this point, and because the long positions have to get out, because, well, where are they going to put the oil? There, they've been told you can't keep it here. If you're gonna buy the oil, you can't keep it here at Cushing. You got to take it somewhere. There's no place to go. You got to sell the contract. Simple as that. So this is more technical than having it as a convergence to the spot price. This is well below the physical market price. That being said, the physical market price is nothing to write home about. I think it's like $2, and that's for West Texas. If we think about Canadian oil, West Canada Select, or Western, I think it's West Canada Select, WCS, that's purely negative at this point. That is purely negative. So if you're an oil company in Alberta, unless you have contracts for delivery at this point in time, shut down, leave it in the ground. Because of this negative pricing, by the way, I think over the next few days you're going to see that a lot of funds have simply blown up. they're done, they're gone. Margin calls were brutal. You couldn't get out fast enough. At the rate that this was dropping, you could not get out fast enough to save yourself. And if you thought, well, the zero will save us, it went all the way down to, I think, to about negative $50 a barrel at one point. Because it was just get rid of it, get rid of it. So if you were closing at negative 50 on a long position, because you had to sell, somebody else had to buy, you had to pay them $50,000 a contract just to get out. Margin calls tomorrow are going to be ugly. Some of these firms are probably never going to meet their calls. Some of them are absolutely done and gone. So I think over the next little while you'll hear about a whole bunch of funds that have simply just blown up over this. This was a pretty bad event. But here's your next month, $20.72. After hours, it's up 33 cents. That's almost meaningless. It was down, I think, almost $4 on the day. Let's look at the term structure. And once we look at the term structure, we'll apply some theory because, well, we want to take everything in the CFA books and we want to apply it to explain what's going on, so we see that what we're learning in there is real. It's not just theoretical, but it works and it applies. So let's have a look at the term structure now. So here's our term structure of oil. You can see that it is hugely upward sloping and then it levels off. All of this back here is rather meaningless. There's no liquidity in these contracts anyway, so these are all model driven prices assuming a constant cost per month. So all of this really is meaningless. This is really where you want to pay attention to. Look at where the next month is. So this would be basically, where are we here? $20.76. And then it starts to level off after that. So what explains this big, this huge slope in the beginning, and then you still have, you can see that the curve takes a while before it levels off. The belief is that the storage problem will solve itself and that storage each month will start to get cheaper and cheaper and cheaper. So that's why you don't have just one upward curve that just keeps going up in a straight line, but it comes up and it starts beveling off. Where are we? 3, 4, 5, about 3, 4, 5 months from now, it's believed that all of that oversupply will start to work itself off. Some inventory levels will come down and there'll be storage room at Cushing to deliver oil. So that's why it's curving off. So we have to keep our eye on the storage capacity and determine from month to month if that is happening. If not, you'll still have that very steep front end of the curve. This is what I've heard called today super contango. I don't think you're going to get any steeper than this. Let's explain that now. All right, so for WTI, the May contract, this is for May delivery. It expires in April for May delivery. And when I first did the screen, it was negative 14. And that was just 5 minutes ago, and we're down to what, negative 16 at this point. The June contract is for June delivery, expires in May. I put down 21. It's roughly about 21 US. We know that to calculate a futures price, we take the spot price and we carry it to the end of the term. And it is the risk-free rate for whatever period of time that we're calculating the futures price, minus whatever benefits that we get, and these benefits are expressed in a continuously compounded rate, plus any costs. And again, these costs are expressed in a continuously compounded rate multiplied by the length of time. The benefits are for a commodity are basically called the convenience yield. How convenient it is to have oil around. Well, there is no yield. There's no convenience to having it around because it's everywhere. You want oil, you can get it. You don't have to hold inventories of oil at this point. And storage. Well, those costs are right up there. So what's going to happen is the forward price is going to be well above the current spot price, mostly because of the costs of storage. So we're getting some idea of what that cost of storage happens to be based on where the physical market is, which is around $2 a barrel versus 20. So it's looking like, well, if the convenience yield is nothing and the risk-free rate over 30 days is what, 0.2%, and that's annualized over 30 days. You got to divide that by 12. Call it nothing. it's all in the cost of carry for 1 month. So you can see how absolutely expensive it is. If you would have looked at the tankers today, the oil tankers, they were all up in price. Why? Because they're all full. I think the estimate was something like 160 million barrels of oil are floating around the oceans right now. Well, not floating in the oceans, but you fill up at the port and then you just drive 5 miles. You float 5 miles out off the coast. You anchor and you say, there we go. So if you're paying 10,000 a day or 20,000 or 30,000 or whatever it is, that's it. You just sit there for the next 30 days, and hopefully in 30 days you could bring it back into port and deliver it. If not, you let it sit. So tanker stocks, all of the oil tanker stocks were up 3, 4, 5, 6% today. Maybe there's something there. Maybe there's more upside to that, more floating supply or more floating inventory. The big danger of that is potentially the U.S. government making a deal with the oil producers to pay them to leave it in the ground. And they're not actually going to pay them to leave it in the ground and say, here you go, here's the money, off you go. They're actually going to buy it from them and say, just leave it in the ground for now. We're going to consider the stuff in the ground part of our strategic oil reserves. So suddenly that storage just got really, really cheap, and you've expanded storage capacity, because if I'm a producer and the government buys my next month's supply, which let's say is 50,000 barrels, they'll just say, well, we'll store it in the ground at your place. Okay, well then I don't have to bring it out of the ground. At some point in the future, I owe you 50,000 barrels of oil. Great. So storage just got super cheap. What's going to happen over here? That cost is going to drop significantly. And if this cost drops significantly, what's going to happen to our forward price? It's going to start to match the physical spot price in the marketplace. So you're not going to have this huge upwardly sloping line from where the spot price is to the next forward month. It's going to start to level off, simply because suddenly storage just got expanded. Storage is super cheap. It's cheap because I'm telling you, just leave it in the ground. So at that point, there may not be demand for more tankers. So that's why I say, I don't know if there's a future. I think maybe what's priced in is priced in right now. What's floating is floating. That's the danger of betting on the tanker stocks at this point, is that the U.S. government makes a deal with the oil producers to say, listen, at least the domestic oil producers, don't pull it out of the ground, leave it there, and we'll agree to buy so many barrels off you, and we'll expand the strategic petroleum reserves. So paying to leave it in the ground ends up being cheap storage. Why would they do that? Well, listen, if all of these oil companies start to fail, there's a lot of debt attached to all those companies. There's a lot of value in the equity. There are a lot of jobs at stake as well. So to step in, and I think it's rather smart. I mean, if you think about it, I'm going to buy oil from you right now. It's super, super cheap. Just leave it in the ground. I get to save you. I get to save your jobs. I get to save your company, maybe save your debt at the same time. So save the debt holders from any burden. And at some point in the future, if it ever gets back to 15 or 20, well, I bought it at 2. Hey, why not give me that oil now? And the taxpayer can then sell that oil in the open market. That's going to leave the oil market, I think, oversupplied for a very long time. So anybody looking at getting into oil now, and I've had that question, what's a great way to get into oil? It's, well, getting in is easy. Are you going to get out without a lot of pain? I don't know about that. But the USO is probably, that's the ETF that tracks United States oil. That's probably the cheapest way to get in. I think it was like $3.70 a share at this point in time. I look at it as just a call option. At this point, it's a $3.70 call option if you want to buy stock. You don't want to buy futures because they expire every month and you got to keep rolling them over. And you run the risk of it cratering on you like it did today, going negative. You think all I can lose is the value of the contract. Well, today it showed you that you can continue losing past the value of the contract. So you can lose more than 100% of the value of that contract. USO, the ETF, I don't know if it could go negative. That's an interesting question. because it does use the futures contract to track the price of oil. It doesn't have physical oil. Could it go negative? That's an interesting question. I don't know that. If anybody out there has any idea of if the ETF itself can go negative, or would it just shut down once it got to that point? Once it got to a certain point, would it just say, that's it, we're done, and shut down before it got to that point? I don't know. Interesting question. Anyways, there's the take on oil. The huge negative today is the futures price that expires tomorrow is below the current physical spot price, only because of that technical difficulty where if you're long the contract, there is no way you can take delivery because there's no place to put it. There's no place to put it. What are you going to do with it? There's nothing you can do. All you can do is sell your contract and close it. So tomorrow will be interesting on that contract. It'll also be interesting, I think, on the June contract to see where that goes. And I think that well before the May expiration, I think you could see the June contract trade down to $10 or $12. Now, if OPEC Plus comes out and says we're going to cut 40 million barrels a day, that's it. This is ridiculous. If we're going to start paying people to take the oil away, we may as well just leave it in the ground. If they do that, and the U.S. also makes a deal to say, listen, we're going to buy the oil, you guys leave it in the ground, you could see a sharp rebound, right? But you're betting on those events happening. Those are the two catalysts, I would say, that would drive oil higher. I would not wait for demand recovery. That is going to be a long time, and you have supply still coming onto the market at this time. Well, that's about all I can say on oil right now. Let's move on to the S&P 500. All right, to talk about the S&P 500, I'm going to pull in some of the concepts we use at level 3 in portfolio management, especially institutional portfolio management, and different institutional investors seeking different risk exposures. So if we think about pension funds, endowments, and foundations, that represents a lot of money in the market. They need growth assets. Look, there's no yield in bonds, and many of them can't go into high yield bonds. It's part of their IPS. So investment grade bonds, you're not going to get any yield there. The theme for the S&P 500, there's nowhere else to go. Where are you going to go? There's nowhere else to go. If you're an institutional investor and you need exposure to growth assets, it's equities or private equity. So if you're going to move into equities, you're very concerned about getting exposure to the equity risk premium, the risk factor. Valuations are secondary at this point. You really want exposure to that because you're a long-term investor. Where is the market going to be in 20 years? Higher. Where's it going to be in 6 months? They don't care. Doesn't matter where it's going to be in 6 months. I need that exposure to growth assets. I'm going to get it with the S&P. You know, we're at 2,800 right now. That seems like a decent enough price. Let's move into that area. Bonds, with the sell-off, bonds really went up, equities went down. So for most of these institutional investors, they were now overweight bonds and underweight equities. So they had to pare down their bond position, and that cash went into equities, which then inflated those particular assets. So they need exposure to growth assets, and they're going to get it either with publicly traded equities or with private equity. Many of them might not have the expertise to evaluate private equity, so they're going to stick with public equities. And they're probably going to want liquidity in their equity position. Where are you going to get liquidity? Large cap stocks. There's the S&P 500, right? They got a long-term horizon. Valuation is secondary. But while we're at it, let's look at valuations. And then we'll do a little bit of a history lesson. And we can, maybe get to the conclusion that a multiple of 21 to 22 might not be unrealistic in a normal market. Let's see what happens here. 2019 earnings on the S&P 500 were about $165. And the market ended December 31st, 2019 at 32.20. But the market is a forward-looking mechanism, which means it's not pricing in the 165. It was pricing in the estimate for 2020 earnings. Expected 8% growth in corporate earnings to 178, which means the market was trading at 18 times forward earnings as of January 1st, if we take the 8% growth as the estimate for 2020, $178 for the S&P 500 earnings. So we're certainly not going to get that now. We're not going to get 178. Let's go run through a couple of scenarios, and we'll see whether or not this market is overvalued at this point in time. Most people think that this is ridiculous. I mean, we're clearly overvalued at this point in time. The market is way ahead of itself. Well, let's find out. And then we're going to bring in a Fed argument to this as well. And once I finish with this argument and the Fed argument, we're going to end with a conclusion about whether or not we'd ever want to short these markets. So if we had earnings of 165 for 2019, let's assume that earnings are going to be 75% of what they were in 2020. We're going to have a 25% drop in earnings for 2020, and then 2021 we'll see a 25% growth above that. So 165 times 0.75 times 1.25, we get to an estimate of 2021 earnings of about 155. The consensus is about 150, so I feel that I'm comfortable in that neighborhood. The consensus is about 150 for 2021 earnings. If we apply the same multiple, 18, a forward multiple of 18, we get to 2790. We're sitting at what, 2800 right now? And if the market is saying, look, this year's a write-off. All right, this year's a write-off. Let's look past this year and let's look to 2021 because that makes more sense. So if the market right now is reflecting a forward earnings for 2021 and not 2020, in other words, it's saying ignore 2020. Just ignore it. Let's look ahead to 2021. That makes more sense. Then we would say that, yeah, we're at 2,800 right now. That's 2,790. It looks like we're fairly priced. So what do we have here? Well, we have an assumption that earnings are only going to drop 25%. We have an assumption that earnings will then recover by another 25% going into 2021, or that over 2021 it'll recover 25%. I don't think that's unrealistic. I think that we have this major drop in earnings once we start the economy running again and getting into next year. Yeah, when you have a low base, 25% increase isn't very much. This is the one that I'd be suspicious about. Only a 25% drop. And then we're applying the same multiple of 18 to it. Does that make sense to apply a multiple of 18, or should it be lower? So I would say that 2790 seems to be about priced almost for perfection at this point. I'd say, I think we're near the upper range, and you can go 100 points on either side. You can say anywhere from 27 to 2,900 if we're cycling in between there. That seems about right if things unfold along these assumptions. What if the market decides that instead of 18 times earnings, it wants to apply a 21 multiple? You could be as high as 3,100, and I've seen some year-end estimates for 2020 at 3,100 on the S&P 500, 3,100. Let's look at some more realistic estimates, I think. Let's say that instead of 25% down, earnings are as much as 30% down, which I think is probably more realistic to be 30% down. And instead of 25% recovery, maybe you only have a 20% recovery. Maybe this is slower to get out of than we thought. Because, listen, we turned off a light switch, but we're not turning on a light switch. We're turning on a dimmer switch. When we say everybody, let's get back to it, a lot of people who were let go are not getting their jobs back because a lot of businesses are done. A lot of businesses, that's it. It's over for them. They're never going to come back. Not only that, a lot of businesses are going to be slow to get back to where they used to be. If social distancing is going to be a thing for a while, then restaurants are going to have to remove every second table. Well, now you only need half the wait staff. You only need half the kitchen staff. Theaters, well, you're going to have to block off every second or third seat. Well, you're not going to have that many people going to theaters. Revenues are going to be slower. Movie theaters are probably going to say, look, there's no point in releasing any movies at this point in time. Any movies in production are probably on hold. So all of that production spending. So think about all the little things that don't just turn back on, right? So that's why I say, well, maybe only 20%, right? So if we take this 30% drop in earnings this year with a 20% rebound in 2021, we get to earnings of 138.60. If we apply the same 18 multiple, again, I'm not moving off the multiple of 18, I get to 2,500. If you think it should be 17 or 16, you get even lower. So there is nowhere else to go. 27 to 3,100 seems to be about the consensus where people happen to be. So would I be shorting these markets at these levels, even though I think, yeah, it should be something lower? Not a chance. Not a chance. One thing that you would have learned since the financial crisis, don't short these markets. No matter how ridiculous you think the valuation is, do you know where we're going? Higher. Why? There's nowhere else to go. There's nowhere else to go. What are you going to do? Where are you going to move your money to? You need growth. For those big institutional investors that need exposure to growth assets, where are you going to go? So what have we seen since 2008 to now? We've seen massive amounts of money moving into private equity. Why? Because the growth assets, equity, were still not enough. They still needed more. Where are you going to go? You got to move into private equity. So you've seen private equity move into assets that they've never touched before, and that the allocations to private equity are getting bigger and bigger. So I expect that there'll be even more movement over the next 5-6 years into private equity, because most of the yield, most of the return on markets are being squeezed out. Now, I want you to combine that with one more thing, which is the Fed. Most central banks have a single mandate, which is to promote price stability. They want inflation, positive inflation, but low and stable, because they don't want deflation. So let's err on the side of caution. Let's get about 2% inflation, nothing more, not too much, and let's keep it stable. Let's see if we can just grow at 2% inflation per year, and that's it. So they raise and lower interest rates to try to make sure inflation targets at 2%. Some central banks have a dual mandate, which is price stability and full employment. So they'll trade off between the two, saying, well, unemployment is high. Maybe we can afford elevated inflation to get that unemployment rate down. So they'll trade off the two. The U.S. central bank is the only central bank that I know of that has a triple mandate: price stability, full employment, and keep asset prices inflated. When asset prices start to drop, they step in to bring those asset prices back up. I don't know any other central bank that watches the market as much as this central bank does in the U.S. So you have a triple mandate Fed: inflation, promote positive but stable inflation, low, positive and stable, promote full employment, and keep asset prices inflated. Are you going to bet against a Fed that wants to do that? Are you going to bet against a Fed that has squeezed everybody out of every other market such that there is nowhere else to go? So if you're looking at these markets thinking, you got to short these markets, I would not short these markets. Don't be a buyer. If you think the valuations are ridiculous, just don't be a buyer. But don't short these, because you're going to get hurt again and again and again. The last 10 years have shown everybody that those who short this market are going to get hurt. Now, you may short the market and it may go down tomorrow, and you may say, look, I shorted the market, but you got lucky. You got lucky, and luck runs out. These markets, where are they going? Higher. Higher. I can say that. Why? Because I got the Fed on my side. I got the fact that there is nowhere else to go. And I got one more thing: history. If you read the Intelligent Investor, which is Warren Buffett's favorite book, if you read that, it was written in the 30s and 40s. You realize very quickly that price multiples of 3 to 4 times, PEs of 3 to 4 times, was the norm. that something that was a price multiple of 6 or 7 times was considered really expensive. That's a really expensive stock. In the 50s and 60s, that moved up to 8 to 10 times was the norm, where 12 to 13 times was a really expensive stock. But then the 80s saw this explosion where suddenly 14 to 15 times earnings made a lot of sense, but 20 was an expensive stock. I think we're entering a period now where 18 to 21 is going to be normal and 25 is an expensive stock. And in 10 years, we're going to look back and say, can you believe we ever were able to buy stocks at 20 times earnings? Unbelievable. What a world that must have been when it was that cheap. Because we can look back at the 1930s and 40s and say, can you believe that they were buying good companies for 3 to 4 times earnings? And expensive companies were 6 or 7 times. Everybody could have made money back then. And that's what they'll be saying in 10 years. Can you believe that people back then were able to buy stock at 20 times earnings? 20 times earnings. Oh my God, how great that is instead of the 35 we're at now. The multiple at which the market was willing, or investors were willing to pay for the market, has been creeping up over the decades. Has been creeping up. So we may be at one of these turning points where suddenly 18 to 20 times earnings is now the low point. That's considered the norm. And we may go to 22, 23 because the Fed has given you no other choice. Think about it this way. There's one man and one woman left in the world. And if you're a guy, I'll talk about the girl. If you're a girl, I'll talk about the guy. One of them is not physically attractive at all. At all. Just a train wreck of a body. And not a nice person. Just a horrible person. Are you going to bet against them having sex? They're the last 2 people in the world. Are you going to bet against them? There's nowhere else to go. There's nowhere else to go. I wouldn't bet against it. And the market is like that right now. You can think of it as physically unattractive and not a very nice place, but where are you going to go? Where are you going to go? If you're an institutional investor and you need equity market exposure, you need growth asset exposure, and you got a 20-year horizon, you don't care. You're simply just going to get exposure to that market and off you go, and probably get it through ETFs. You're not going to pick and choose. You're going to get it through ETFs. And well, when you're buying ETFs indiscriminately, the market goes up. So that's my take on it. 2,800, yeah, not surprising. Could we revisit 27 or 26? Yeah, but I think that the market would be quickly bought up or quickly bid at that point. Could we see 3,100 by the end of the year? Yeah, you probably could. Could the economy continue to degrade and the market go up? Yeah, because the market is going to look past this and start pricing in 2021. So no matter what happens now, they're going to say, yeah, we know that. 2021. So as each day goes by, we get more and more visibility. Right now, we have hope and reality. And the spread between hope and reality is very high. Now that spread will contract over time, but the belief is that reality will rise to hope. So that the spread will decrease by reality increasing. Only with time, and we see reality not increasing, will the spread between hope and reality decrease. And when that happens, then the market will drop at that point in time. Are we going to revisit the lows that we had? I don't think so. And this is why. Any market sell-off, that first drop, that first big drop that you have, that's not a valuation drop. That's a liquidity drop. That is selling based purely on liquidity. Valuation doesn't matter. I need liquidity. You have margin calls being tripped every day. The lower the market goes, the next day margin calls have to be met. There's more selling, which trips even more margin calls. There's more selling. So that first drop was liquidity, all liquidity. We got to get that under control. Then you had that bounce. And it didn't stop. It just kept going up. Now is when we start thinking about volatility is dropping a little bit. It's pulled off. The liquidity selling is over. So I don't think you're going to have those rapid declines again. If we go lower, it'll be in stages, 50, 60, 70 points at a time. mixed with rallies up and down. If you go up, I don't think that you go up by 200 points anymore. I think it's 50, 60 points up, and then it'll slowly sandwich to 40, 50 points either way. But I think if we look for a market over the next couple of months between 27 and 29, yeah, that's probably a high probability. Can we see it dip below 27? Yeah, but with lesser probability before you find a solid bid. Can we see it peak above 29? Yeah, I think you could. Should you buy this market? That's up to you. Should you short this market? No. No, do not short these markets. You will get hurt. Just simply not buy. That's just my own opinion. You may have a different opinion, but there we go. That's about the best I have to offer on both oil and the S&P 500.